Okay, so Upstart's latest earnings call was, well, a real head-scratcher. We saw this massive flood of people applying for loans, but then, surprisingly, the number of actual loans they gave out slowed down. And that disconnect, that paradox, became the absolute center of gravity for the entire Q&A session with analysts. Everyone wanted to know, what is going on here?
So this was it. This was the question that really framed the entire conversation. How on earth can you have your best demand in 3 years? I mean, people are lining up for your product, and at the same time, you miss your own targets for transaction volume? It's a puzzle, right? And it had every single analyst digging for answers. And here's where you can really see that contradiction in black and white. On the one hand, look at that, a huge 30% jump in applications. Just massive demand. But then you look at the other side, and the conversion rate, the number of those applications that actually turn into loans, it actually dropped. And that gap is exactly what analysts jumped all over.
All right, so the mystery is set, and the investigation began pretty much immediately. As the questions started coming in during the Q&A, it was obvious that everyone from Mizuho to Needham to Citi, they were all pointing their questions at one single suspect, Upstart's AI model.
And you can just see the pattern here, right? Dan Dolev from Mizuho kicks things off with the big one. How do you square these two things? Then you see the others start drilling down. They're asking, okay, where exactly did the model get tight? And what did it see that maybe the rest of us are missing? They all wanted to pop the hood and see why the AI hit the brakes right when demand was hitting the gas.
So here's the play-by-play that Upstart's leadership laid out. They said it all started when their AI model noticed this small, just a little tick up in macroeconomic risk. And in response, it did two things automatically. One, it cut back approvals for a small slice of people. And two, for the people it did approve, it nudged their interest rates up just a tiny bit. You put those two things together and boom, that's what pushed the conversion rate down. Now this is probably the most counterintuitive piece of the whole puzzle. You'd automatically think, right, that the AI would get nervous about subprime borrowers. But that's not what happened. The CFO, Sanjay Datta, he explained that their data was showing that default rates for prime borrowers, we're talking good, 720 to 750 FICO scores, were actually trending worse compared to pre-COVID levels than the subprime group was. The AI saw that very specific signal in the data and reacted to it.
So you've got this intense grilling from Wall Street. How did Upstart's leadership handle it? Did they backpedal, apologize for the miss? No, not at all. Instead, they came out with this really strong defense of their system, basically arguing that what looked like a problem was actually the system working perfectly. And this one quote from the CEO, David Girouard, just sums up their entire position. He said it point blank in the Q&A. He framed the AI's caution not as some kind of mistake, but as a core, built-in feature of the entire platform.
So what does that actually mean, a feature, not a bug? Well, the bottom line is this. Upstart is arguing that they would much rather have an AI model that might, every now and then, overreact to a potential risk than one that underreacts and gets caught completely by surprise in a real downturn. For them, that super fast reaction, that conservative breather, is proof that the system is doing its job to protect their partners for the long haul.
And their argument goes even deeper. The CTO, Paul Gyant, he pointed out during the Q&A that traditional credit models are always looking in the rearview mirror. It can take them 3, maybe even 6 months to finally catch on to a shift in the economy. Upstart's whole bet is that their AI sees those tiny, real-time changes the moment they happen. It gives them a huge head start. Okay, so while they were passionately defending the AI's reaction, they also kind of admitted that, yeah, maybe it was a little too jumpy this time. The CEO even used the word overreacting. They know there's a fine line between being responsive and just being, volatile. And they're not just talking about it, they're already on it. Paul Gu went on to explain they've come up with new ways to handle what he called statistical sampling error. What's the goal? To slash that unwanted month-to-month volatility in half. They want a smoother ride, a system that's less likely to react to what might just be a false alarm. So let's zoom out a bit and look at the bigger picture here, because this whole situation naturally led analysts to another really sharp question. If Upstart's AI was pulling back, then how come some of your competitors are out there posting really strong growth numbers? Upstart's answer to this was, wow, just a total declaration of faith in their tech.
David Girouard said it as plainly as you can. In our view, the model is always right. We don't overrule the model. And the implication there is pretty obvious, right? If other lenders are growing faster, Upstart is suggesting it's because they're taking on risks that Upstart's AI has specifically flagged and is steering clear of. Now, while all this drama was playing out in their personal loan business, Upstart was also busy building up its other businesses for the future. In auto lending, they actually doubled their number of active dealerships in just 1 quarter. And for home equity loans, HELOCs, their automation is just taking off. Automatic approvals went from basically 0 in June to 20% by October. This is the long game they're playing. So after all the questions, all the detailed technical explanations, where does this all leave us? What are we supposed to take away from this really complex picture of Upstart's strategy and where they're headed? I think it all boils down to this. Upstart is making a very clear, very conscious trade-off. They are betting the whole farm on the long-term accuracy and integrity of their AI platform. And if that means they have to miss some short-term volume targets, so be it. They believe that proving their model is better at managing risk is how they'll ultimately win. And that brings us to the big final question that hangs over this whole story. Is Upstart's AI a cautious genius that's seeing real risks that everyone else is just blindly ignoring? Or is it an oversensitive system that's holding back growth for no good reason in a really competitive market? The answer to that question is probably going to define Upstart's next few years, and maybe even the future of AI in this entire industry.